Okay, everyone, welcome back to school. So this is week 3, and this is today's agenda. So I'm going to go over the quiz from last week. Again, 2 questions. It's extra credit. Don't worry if you didn't get it. There's going to be lots of opportunities to do it again. So I'm just going to go over the solutions, and I think half of you, filled out early and didn't fully process the notation that I was using. But I think you guys get the concept. So I will just go over the solutions and then just remember the notations I'm going to use throughout this course, and so that you don't make the same mistake twice. Then I'm going to go over some Q&A questions that students ask me, and I'll provide a response. And then I'll go over triangular arbitrage, which was the last thing we talked about, the last exercise we talked about before we went on break. And I think a lot of you, I think I went through it too fast. And some people sent me some questions about it during the break, so I'm just going to go over it very slowly so that everyone understands how to do it, how to solve the problem, as well as the intuition behind why it's solved this way and the way I do it. Okay, and then I'll go over the ungraded problem set number 2. So today is mostly just, I guess, going over practice problems and kind of get familiar with the kind of questions that I may ask you on the midterm. And then for the rest of the day, our lecture is on transitioning from the covered interest rate parity to a so-called asset pricing model, or an asset approach model, in which we're trying to derive an expected returns model based on CIP. Okay, so we have to add additional assumptions so that we can basically swap out the forward price for an expectation on the future spot exchange rate. So that's how you get the returns. And I'll talk about the math that's needed to do it, and then also the economic assumptions that we need to borrow essentially to make it tractable for this class. All right, so that's our schedule for today. So let's go over the quiz. So I think these quiz questions were very easy. So just testing your conceptual understanding of how to read FX quotes. So this question is basically asking you if you have some currency. Here CAD stands for Canadian dollars, so if you didn't know what that was, that's what CAD stands for. You could have Googled it. Canadian dollars, it goes from a price of 0.6 US dollars to 0.8. So I think a lot of confusion for students in this class is they tend to think currency is something that's different from assets or commodities. So remind you again, your life will be a lot easier if you start thinking about foreign currencies as just another asset class. So in that sense, then it's easy to comprehend what goes on when you think about a specific currency that has price fluctuations, right? So you have a price fluctuation going from 0.6 to 0.8. So thinking of it as a commodity or just another asset, the asset price is going up, right? So in this class, when we're thinking about currencies, when asset price goes up, one currency has to get stronger and the other gets weaker. So this asks you, in this case, in which Canadian dollars, the price goes up in terms of US dollars. So for fixed amount of Canadian dollars, you need to bring more US dollars. That means US dollars is getting weaker. Conversely, said in another way, that means that Canadian dollars are becoming more expensive or Canadian dollars becoming stronger. So if we just, based on that intuition and understanding, you can kind of eliminate 2 of these answers already, right? Just thinking about Canadian dollars, right, perspective, we know that Canadian dollars are appreciating in value. And so any possible answer in which there's a mention of depreciation on the Canadian dollars is wrong. So B and C easily eliminated. So the only answer really is A. And we can just go ahead and read A and just confirm our intuition, right? CAD, increase in price in terms of US dollars. Okay, so obviously CAD appreciated, and Canadians will find US goods and services cheaper. Yes, right? Relatively cheaper than before. The reason is because we're assuming that prices don't change, but the Canadian dollars can get more US dollars, and in that sense, you can buy more goods and services, right? So that's the underlying assumption. Prices don't change, and we're only thinking about the increase in price of Canadian dollars relative to the US dollar. US dollars can be bought, more of US dollars can be bought with the same amount of current Canadian dollars, therefore they can buy more US goods. Yes? So A has to be the answer, and again, I highlighted the intuition down here as well. Okay, I think most of you got this. Maybe just a hand, maybe just like 1 or 2 probably guessed the answer, but I think most of you got this question. All right, so I think this is partially My fault. I probably should have just wrote explicitly what this term means. So just to remind you, in this class, whenever I write in this format, from left to right, I'm writing the currency in the denominator. I'm writing the first currency first from the denominator. Okay, so here we're talking about US dollars that I want to think about buying or selling. That's the foreign asset here, the foreign currency, and it's being priced in terms of euros. Okay, so whenever I write this in this format, for this case, US dollars / euro, I mean the price of US dollars in terms of euro. Okay, I'm doing this because most trading platforms that you'll probably engage in the future will quote foreign exchanges in this fashion. If you look at Bloomberg, you look at other platforms like Interactive Brokers, or even more retail stuff like, I guess, Charles Schwab. I don't know about local banks, but they all quote foreign currencies in this way. Okay, they always quote the foreign currency first, followed by the domestic currency. All right, so given this quote, you can already first, number one, determine which one is the so-called foreign currency, right? The foreign currency is always listed first, followed by the domestic currency. Once you establish what is foreign and what's domestic, you can figure out what these interest rates are referring to, right? So we know that US and euro is 10%, 9% respectively, and US dollar is the foreign currency. Therefore, R star is going to be the 10%. Yes? Followed by euro. Euro is the domestic, and we know the interest rate for euro deposits is 9%. So R without the star is 9%. So once you assign R and R star, and you know what E is, you can write out the CIP equation, right? So yeah, so we determine which one's the foreign currency, which one's domestic currency. We know R star, we know R, we know E. We can write out from left to right the CIP equation. Domestic on the left-hand side, foreign on the right-hand side, and you plug in E and you solve for F, right? And you get some number, and you realize the closest number is A. All right. So again, if you look at like test prep books for CFA, they might switch it around. Okay, just letting you know that's possible. But again, in this class, reiterate again, when I write this expression, I mean foreign first, followed by the domestic currency. So once you understand that, it's easy to figure out which ones are star, which country is R, which country is R star. Then you can just plug directly into CIP and done. Solve for whichever parameter that you need to solve, and that's it, right? All right, I think half of you got it because you didn't fill out the quiz until after I finished class, and the other half probably you guys did it ahead of time and forgot that in this class I have this notation here. So I see it as most people got the concept, so you just need to remember that when in this class, on my midterm, on case studies, when I write in this format, that's what I mean. I'm going to list the foreign currency country code first, followed by the domestic country. Comments, questions on last week's quiz? OK, so there's going to be another one today, so another chance for you to rectify your mistakes today or last week, so don't worry. All right, so I'm going to go over Q&A questions that students gave me through email now. So I think these questions are just conceptual questions. So somebody asked me, how do you interpret forward premium in CIP? Again, the forward premium is just the F minus E over E term. So if you look here, right, this F over E, of course, you can expand this to 1 plus F minus E over E. The ones cancel out. So the F minus E over E expression is referred to as the forward premium. And so if you look for today's lecture, the intuition will be much more clear. So you should think of F minus E over E as an expectation about the future spot exchange rate. So spot exchange rate today is the exchange rate is the price you can buy a certain currency at this moment now, times 0. Okay. The future spot exchange rate is what that exchange rate is going to be, 1 year from now, 2 years from now, 5 years from now, sometime far in the future. And F is one way to kind of gauge the expectation, right? So if you look at the forwards market, that's exactly what people are trying to do. They're trying to figure out. It's like a betting. It's it's a betting market where you're trying to figure out, with the information they have, whatever the traders have, what the appropriate fair value of F should be, right? And that's supposed to be a measure of what the future spot exchanger should be. And the reason why that's the case, as I will show you, is you can see it from the returns, the so-called forward returns, which I'll explain soon. Okay. But in any case, it's in the next Q&A question. But for now, to answer this question, just think of the forward premium as expectation about the future spot exchange rate. There is a term to characterize that intuition called the unbiasedness hypothesis. So this is not mentioned in your textbook, I think. But if you Google this or you Wikipedia this or even in your CFA practice textbook, they have some mention of this. And what this means is that the market, the market participants in the FX markets will, on average, be correct in forecasting the future spot exchange rate, right? So deviations from this, there's special terminology, which I'll get to it much later in class. But that's what you should think about F, okay, from CIP. It's an expectation. So that's what E here means with the brackets. Expected value, taking the average, of the future spot exchange rate sometime in the future. So I don't know if people are familiar with this notation here, so maybe I'll highlight it here. So this is, of course, like statistics notation. You may have seen it in your other courses when you think about CAPM or when you run regressions to estimate CAPM. If you're taking statistics, you must have seen this. So this is just another way of saying average. Okay, average or expected value of future spot exchange rate. All right. So I will go over examples of how to think about this in discretely, I suppose, in like a roll of a dice. But I hope most of you've seen this term before. Okay, so just think about people have certain beliefs about what the future price of a foreign currency will be, and we're simply just averaging it across all participants in the FX market on their beliefs. And obviously, if you're very confident in your belief, you should actually make a trade if you're going to make some money. And once these participants execute their trades, that's going to be reflected in the forward price, right? If you truly believe in what you believe, you're going to make a trade so that you make a profit about the future expected value of the foreign currency, and simply taking an average should represent what the forward price should be. All right. Okay, so why would someone participate in a forward market if they're not hedging, like against risk? Well, you can make a return. So as I said, forward market is basically a side bet. Like it's a betting market on the future price of something, right? So remember that forward contracts, it costs nothing to engage in it, right? So just like a gamble, you don't have to pay to gamble, right? You pay once you lose, right? So the return on the forward contract depends actually. So the return is different from the forward premium. Okay, so I remind you again, the forward premium is the difference between the future price and the spot price today. Yes, and the F is supposed to represent beliefs about what that future spot price should be. But you can actually enter a forward contract expecting a return if you decide to, for example, take advantage of what the current spot price is in the future. So what that means is that if you engage in a forward contract, your return is therefore defined as the difference between the future price or the forward price against the actual realized spot price in the future. So if you look at this term here, right? Suppose I go in a long forward, so that means I'm going to engage in a bet with somebody that basically I'm going to bet that the price of the actual spot exchange rate is going to exceed the price I'm going to pay in the future. Yes? So let me say that again. long forward contract. What does that mean? Long forward contract means that there's one that I am taking on the position of receiving the underlying asset, or in this case, the foreign currency in the future. Yes, long forward means buying something. I'm going to buy the foreign currency in the future. But in that future, I have to pay some money. Yes, it's a fixed amount I know today. I can make a positive return if the future price of the underlying asset exceeds the price I promised to pay today, as reflected by the forward price, right, the future price. So therefore, my return is not based on today's spot price, but the realized spot price sometime in the future. So to answer this person's question, who is asking what is the forward, basically, is the forward premium a return? It is not. Okay, a return is the comparison between the realized future price versus the future price, or the forward price. So in the case I'm long forward, you can think of it in two ways. One is a bet, one is a hedge to remove risk, right, FX risk. The other interpretation of a forward contract, a long forward contract, is I'm wagering, or I'm betting, that the underlying asset will exceed the price that I will pay in the future. Yes? So maybe a timeline is helpful here. So let's do a timeline. We have time 0. I'm going to do t equals 0 for time 0. And I'm going to do t equals 1 for some time in the future. So if I'm long forward, my forward contract will cost me nothing, but I will receive foreign currency and pay F, right? F is the domestic currency, whatever that is, say US dollars. But at the same time, something's changing between time 0 and time 1, right? The underlying asset, in this case, is foreign currency. So two things you should note is that E0, E naught, I'm going to say naught sometimes for E0, so E naught stands for time 0, the spot exchange rate. And I'm going to denote E1 as the realized spot exchange rate, FX rate. Okay. So to clarify again, forward premium is F minus E over E, whereas the forward return, the so-called return, is E. So maybe I write E naught. Is E1 minus F. And you can make it as a return if you want. Okay. This is forward premium. And this is okay. All right. So let me summarize again. Student asked me the following question. Is the forward premium return? It is not. It is an expected, you can think of it as expectation about what the future value of the spot exchange rate would be in the future. So F, therefore, is a reflection of what that rate is. It's not a return that you actually receive. All right? All right, so that's the forward premium. Now the forward return depends on the realized value of the spot exchange rate in the future. We don't know what E1 will be at time 0, correct? It's some realization, whatever it is. It could be something different, it could be lower, it could be higher, right? So this is risky. But if I were to think of a forward contract as a return in a long position, right? It depends, therefore, on what E1 is. Right? If E1 is below F, then then I lose money, right? That means I have to what this means is that I'm actually selling the underlying asset after delivery, right? So remember why it's minus f. It's minus f because I'm paying f to receive the underlying asset. But then it's positive here. E1 is positive because I'm selling it on the FX market immediately. So therefore, this is my return. Okay? So if we look at this timeline, you can see what's changing, right? At time 0, I engage in a long forward contract. It costs me nothing to engage in it. I will receive the foreign currency. I will pay f. A return is therefore calculated if I decide to sell immediately the foreign currency I receive. That's where this E1 comes in. So the forward return, as you can see, is very different from the forward premium. So this I will talk about last 5 weeks of class, right? 3 to 5 weeks of class where I talk about forward contracts. But anyway, this is a preview of understanding forward contracts and how you would make money from it. Okay, but we're just going to be focusing on so-called forward premium for now. And yeah, so I apologize if there's new stuff, new terminology I'm introducing, but hopefully it's okay. Comments, questions on this difference between forward premium and forward return? Okay, cool. All right, so I'm going to review the triangular arbitrage part of last week's summary slides. So I brought it up here again, so maybe I'll just talk about this again. So this is the same slide from 2 weeks ago. So let me just summarize what's going on here. So you have three sets of currencies, or three currencies. You have US dollars, euros, and British pounds. And basically, I'm asking you to find an arbitrage opportunity by starting from one currency and circling back, right? Going from, for example, you can go from US dollars to euros to British pounds back to US dollars. Or you can go another route. Instead of US dollars to euros, you can go US dollars to British pounds to euros and then back to US dollars, right? It's called triangular arbitrage because a lot of textbooks like to write it in a triangle format. So maybe I'll do the same. Let me draw some triangles here for you. So in the first case, we have US dollars going to, let's do here, US dollars to euros to British pounds. And this one is going from British pounds to euros and to USD. Right? Okay, and let me draw some arrows for direction. So USD to euros this way, and euros to British pounds, and then British pounds back to USD. And then for here, we have British pounds going to euros, euros to USD, and USD to British pounds. The reason why they use triangles is because you can start any corner. Okay, it doesn't matter, and you will lead to the same conclusion whether or not there is arbitrage profits. So in this case, I started from USD, but you don't have to. You can start from euros, but as long as you go through the same chain of currencies, you will reach the same conclusion that there's either there is or there isn't arbitrage profits. The same thing for in the scenario in which there is no profits. So in this case, you have British pounds to euros to USD back to British pounds. If you start from euros, it's okay too, as long as you circle back the same route, you will reach the same conclusion that there is no no free lunch in this trading strategy. Okay, so I will give you my way to do the question. So it's kind of just an agnostic way of solving this. You don't have to understand the intuition. Anyone can do this. You just follow exactly the steps I do, and you'll reach the answer. And then I'll give you the intuition of what exactly is going on when we do these triangular arbitrage. Okay, so let me go back a slide. So this is my way to do it. Okay, so the first thing I do when I approach this problem is I identify the base currencies. So when you look at quotes, in this case you have quotes listed in the first column, USD to euro, British pounds, and the price in terms of euros, and British pounds price in terms of US dollars. The base currency refers to the currency you can buy or sell it at. So that means it's the foreign currency or the leftmost currency code in this column. Okay, so identifying the base currency in this case, it's US dollars and British pounds. So I'm going to start my loops with either USD or GBP. Okay, the reason I do it this way because I'm trying to approach this the more intuitive buy low, sell high strategy. Okay, and I'll explain to you why it's a buy low, sell high strategy. But let me finish going through my steps. Okay, so pick one base currency, and so I'm going to start with USD, for example, and construct a chain of conversions that loop back to the base currency. So if you have ABC, right, in this fictitious case, ABC currency, I go from A to B to C and then back to A. So I have to think about which currency to buy and sell, but as long as I hold on to that currency after the step, then it's fine. You get to think about how I get there, though. So going from A, I could be selling A, I could be buying B, right? Buying B or buying B or selling something to buy B, right? Some way to get to B. Okay. To reiterate, this path is not unique, right? You don't have to start with A. In this case, you can start with B. But as long as you go through the same chain, you should reach the same conclusion. Okay. But going for these routes, these alternative paths, there's a different interpretation of the arbitrage strategy. Okay, just letting you know. So remember, if you start with the base currency, you're approaching the problem from a buy low, sell high perspective. If you start from any other currencies that's not a base currency, it's going to be something else. But you will reach the same conclusions. All right, so after you picked the base currency and you identified a chain, you then try to outline conversion steps, started with the borrowed currency, which is in this case A, and try to circle back to A again. But you have to go through each of those currencies. You have to end up holding each of these currencies after each step. So the idea here is that after you go through this chain of currency conversions, you should come out more than what you started. That's the idea. Like you've basically created a money machine. Like you put in something, you get something plus more than what you started from. Okay. So if that fails, if you don't get more than what you started, then you can try a different route. So rather than A to B, you can go to A to C to B. A to C to B, and then back to A. Okay. But in this case, I start with B. So as long as B is going not to C but to A, you'll get the same conclusion. Again, the reason why I go with B is because you get this buy low, sell high intuition. Okay. So let me go to the intuition then. So what exactly is going on when you borrow the base, which is what I suggested? Well, when you borrow the base, what you're doing is actually you're borrowing the currency so that you can sell it at a higher price. And then you're buying back to cover your original loan. Okay? So when you borrow, in this case, as I said in this example, right, identify the base currency and borrow the base currency. So what you're trying to do is basically borrow the currency and try to exploit it by selling it at a higher price and then buying it low somewhere else to cover your loan. And you can see this, right, through the step. So you borrow this, you're selling, and then you're buying. So you basically created an implied exchange rate between USD and GBP, right? So you're comparing this implied exchange rate to the actual quoted GBP at the last step. And so as long as this, 1 over this, so you can invert it, this price exceeds this price, which it will in this example, then there's arbitrage profits, right? Because it violates the law of one price. So you can check this yourself, right? Going from USD to British pounds, this is the first bullet point here, okay? Going from USD to British pounds. you will arrive after this step at an implied exchange rate for the price of USD in terms of British pound, some value. Once you take the inverse, you'll realize that this price, which is now this, right? It looked like this, right? Once you take the inverse, this price of British pounds in terms of USD will be much higher than this price. Law of one price says this can't be possible. There's free money on the table in this scenario. Therefore, what you're doing when you're converting from USD to British pounds is you're selling high and buying low, okay, after this step. So that's the intuition of when you borrow the base currency, right? You're comparing the implied exchange rate to the quoted exchange rate and realizing that there's a market in which you can sell a certain currency at a higher price, and then you buy to cover your original loan. All right, so what if you don't start with the base currency? Well, if you don't start with the base currency, then it's a different interpretation. So what you're doing when you borrow some other currency other than the base currency, you're performing this trading strategy. You're borrowing the quote currency now to buy cheap, okay, and try to sell the currency you bought cheap at a more expensive price. Okay, so if you look at this chain of currency conversions, you'll see that this chain is identical to this chain, right? USD, Euro, British pounds, USD. Here we're starting from Euro, but Euro matches with this Euro, going from Euro to still British pounds, right? To USD, back to Euro. So it's the same triangle. It's the same triangle. We're just starting from a different currency, right? We're not starting with the base currency. We're starting with the quote currency. You start with the quote currency, the intuition is different now. Okay? But at the end of the day, you're still comparing an implied quote to an explicit quote, a direct quote. So here you're comparing the implied quote after the third currency conversion, right? You'll get a exchange rate for Euro to USD, and you're comparing it to USD to Euro. You can take the inverse and realize, in this case, that this currency is going to be higher. The price of USD in terms of Euro is going to be much greater if you take the inverse here. You can double check yourself, okay? So in that case, you are buying cheap, right? You are buying USD at a low price and attempting to sell it at a high price with the explicit quote. Okay, so maybe summarize again what's going on here. So what I basically gave you is a bulletproof strategy to solve any triangular arbitrage problem. The hard part is probably outlining the convergence steps, right? Because when you outline the convergence steps, you have to think about which currency to buy or sell. Depending on which currency you buy or sell, then you have to identify whether or not which quote to use, right? Either the bid or ask. But once you've established the chain of currencies to convert and which bid or ask quotes to use, you can quickly figure out whether or not this chain sequence of currency conversions will yield more than what you started from. If you don't, then try the other route with a different base currency, right? Different sequence. So therefore, there's only basically two cases to check, right? Two base currencies. If one route doesn't work, try the other base currency, but change the order. And then if nothing works, then nothing works. The market is efficient, right? That's what it means. So in this case, these two bullet points exactly doing the steps I just outlined. Look at the base currencies, borrow the base currencies, and check the sequence, arbitrary sequence, right? Here I checked from USD to Euro. The second bullet point here, I checked from USD to British pounds. Yes? Different sequence, starting with different currencies, but it doesn't matter which currency you start on the triangle, you'll get the same conclusion. Okay? So this slide just gives you the intuition behind why we start with the base currency. If we start with the base currency, it's it's the more intuitive buy low, sell high argument, right? So if you think about the chain and you stop at the chain right before the last conversion, you'll realize that you've basically computed an implied exchange rate. And from going from the third step to the last step, you're comparing the implied exchange rate to the explicit direct quote, right? And in this case, you'll see that this quote here, if you take the inverse, is going to be larger than this quote, and therefore you're basically selling high and buying low. On the other hand, if you don't borrow the base currency, you borrow the quote currency, the intuition is slightly different. Yes, you'll see that the implied quote is going to be the inverse of the implied quote is going to be lower than the direct quote. And so what you're essentially doing is buying cheap and trying to sell high somewhere else. Okay? All right, comments, questions on triangular arbitrage. So I obviously won't ask you to regurgitate, the intuition that I just explained to you. And at the most, I will ask you to identify whether or not there is an arbitrage opportunity here. And you just have to, show the steps, show the sequence of currency conversions, make sure you choose the right bid and ask quotes to use, and either show me that there is no opportunity, no free cash on the table, or if there are. And if there are, you have to calculate, show me that you get more than what you started. Okay? Comments, questions? So there is a easier version of it in the problem set that I gave you 2 weeks ago. So if you don't have any questions about the lecture 2 weeks ago, I'll just go over the problem set here. Okay, so let's go over the problem set. So let me bring up the homework question, actually. Okay. All right, so this question is easier than the example I gave you because there's only one quote listed. Okay. But anyways, I will walk through the steps to solve this question, and no one should be lost this time. So actually, this question is even more direct. They tell you which currencies to start with and to convert. So you don't have to think about the different sequences, right? So there's only one sequence to check, and this is going from euros to British pounds. So I won't read the prompt because it's a bit lengthy. But basically what the question is asking you to do is start from euros, some quantity, I believe it's $10 million, and go from euros to pounds to USD and circle back to euros. Okay, and again, because it's only one set of quotes instead of a pair of quotes, bid and ask, this is very, very straightforward, right? You don't have to think too much. All right, so so borrow low, sell high. That's basically what we're doing. So what are we gonna do? We're gonna borrow 10 million euros, and the first thing to do, based on the quotes, is to buy British pounds. Right, buy British pounds. It's one of the base currencies, so it doesn't matter here because buying and selling because there's only one set of quotes. Okay, but in any case, we're starting from euros, we're going in from British pounds, so this is the relevant price, and it's going to cost, 1 British pound is going to cost us 1.1555. Okay? All right, so that's step one, right? So at the end, we will arrive at this expression here. I think this is intuitive, right? Whenever we're buying something, we should be dividing by the price to get the number of units afterwards. Yes, so let me say that again. Whenever we buy something, the price represents a price per unit. So if we want to know the quantity of units we have after we're buying something, we should be dividing. So in this case, if we have 10 million euros, we divide by the price. We divide by the price of 1.1555 euros. We should get pounds, right? The number of pounds. So this fraction here represents the amount of pounds we get after converting euros to British pounds. The next step is going from pounds to USD. We can do that by selling pounds. It's a sale because here, right? It's a base currency, so we're selling it for US dollars. We're selling it at the price of pounds, 1.5386 USD per pound. So whenever we sell something, we multiply by the price to get the total revenue from that sale. Yes? So let me reiterate it again. Whenever we're buying something, we're dividing by the price. Whenever we're selling something, we multiply it by the price. Okay, so that's why it's a multiplication here. So just hopefully more intuition makes the math more readable. All right, so quantity of British pounds, and then sell all our British pounds for US dollars. So we multiply by the price. We get 10 times 1.332. Yes? So this is our implied euro to USD exchange rate because we started from euros, right? And we're selling it or converting it to USD. And so the implied quote up to you include these two conversions, right? This term divided by this term, 1.5386 divided by 1.1555, that will give you this 1.332. Comments, questions? So maybe I may need to highlight that where this comes from. This comes from 1.5386 divided by 1.1555. Okay? All right, so just like I mentioned from a couple of slides ago, we can actually take the inverse of this exchange rate to get the implied exchange rate of USD per euro. I mean, the price of USD in terms of euro. Correct? Take the inverse, you should get 0.75. If we compare 0.75 to the explicit quote, which is here, 0.76388, I can show you on the homework assignment. Right? This term here, right? You can see that there is a price discrepancy, right, for the price of US dollars in terms of euro. The direct quote is 0.76388, but our calculated implied quote gives us 0.75. Therefore, US dollars is cheaper if we take advantage of the implied quote. Yes? So it's a buy low, sell high strategy. So obviously, if you look at this conversion here, 1.332 times 0.76388, that's going to give you some number greater than 1. You can do the math yourself, but trust me, it's greater than 1. So some number greater than 1 multiplied by 10 million will give you more than 10 million for sure. So there's your arbitrage strategy. Okay. All right. So of course you don't need to outline what the implied quote is when you do the exam. You just need to show me the current steps to do your currency conversion, going from euros to British pounds to USD to euros. But I did this here again to highlight the intuition behind a triangular arbitrage. Okay, we're essentially comparing the inverse of the implied quote to the direct quote, and if there is a price discrepancy between the price of, in this case, US dollars in terms of euros, you can take advantage of that price discrepancy. Okay, comments, questions on the first question of the problem set? All right. Second question is related to CIP, but with with interest rate quotes at different time horizons. Okay, so I kind of warned you about this 2 weeks ago. So in this example, so I won't read the prompt because I think the question is straightforward after you kind of distill it to its mathematical terms. Okay, so this is the setup. You have an exchange rate E equal to 1.2834 for US dollars for 1 unit of euros. Okay, so here you can clearly see again that the foreign currency we're talking about is euros. Domestic currency is US dollars. We have a future or forward contract, the forward price, equal to 1.2779. This subscript 0.5 means that this forward contract is for the delivery of the foreign currency 6 months from today. Okay. So the problem with this, I guess the complexity of this issue compared to our previous examples in class comes from the fact that we have interest rates that's at 1 year horizon versus a forward contract that's only for a 6-month investment or delivery horizon. We can still solve for the interest rates here, but we just have to do some compound frequency conversion. Okay, and I think rather than give you the formula, I'm just going to give you the intuition. Okay, so just note that based on F and E, we have a CIP equation already, right? We have 1 plus R subscript 0.5 equal to 1 plus R star subscript 0.5 times F over E, right? This is the CIP equation, but note that we are only given R1, right, for 1 year. So R1, again, indicates 1 year deposit return. But we have CIP, however, for 6 months. So we need to somehow get our 6 months from R1. How do we do that? Well, we note that we can actually derive our 0.5 from R1 if we note that if we basically put money in a 6-month deposit and roll it over, that should give us equivalent to the periodic return of 1 year, right? No, in both cases, I'm basically holding the money in the bank and not taking it out, right? So I'm locking my money away for 1 year. So there's basically no difference in like the mechanism to make money. Okay. If this is not an equality here, then I'm going to argue that there's going to be arbitrage. Okay. So these compounding formulas that you've seen in your classes, it comes from arbitrage, an arbitrage argument. All right. So it's a square here, because we're basically keeping the money in the deposit and rolling it over again for another 6 months. So it's a reinvestment. So that's where the square means. It's a compound. It's a 6-month compound. Okay. So let me say that again. We're trying to get our subscript 0.05 from R1, and we're trying to do that by noticing that there's a relationship between these two types of investments, right? One is putting your money in R1 for 1 year, not touching it, versus putting your money in 6 months and then rolling it over for another 6 months, reinvesting it, and so that their maturity term is the same, identical maturity term. It's a squared because I'm reinvesting what I got after 6 months back into the same 6-month deposit. Okay? I'm claiming that if it's not equality here, there's going to be arbitrage. And I hope that's quite obvious, right? If there is a deviation away from equality, you would just borrow from the low interest rate and invest in the high interest rate, right? The higher return. Whichever investment gives you higher return, just borrow from the low one and invest in that one. I think it's clear. I hope I don't need to explain why. So this equation here, yes, it must be true. All right, so if this equation holds, we can obviously back out our 1 plus r subscript 0.5 by square rooting both sides, correct? So square rooting both sides gives us 1 plus r 0.5 equal to 1 plus r1 to the 1/2 power, or square root, equal to 1 plus r star 1 square root. It's square root again because of this identity again. We're just swapping 1 plus r star 0.5 for r plus r star 1 to the square root power, or it's just square root. Okay? And then just solve for r1 star. The question is asking you to solve for r1 star as opposed to r 0.5 star. All right, I think very straightforward if you have an intuitive understanding of compounding interest. Okay, but if you don't, then you can simply memorize the compound equation, and that's fine. You get the same answer. Questions, comments? So big picture, I think it's a very easy question, right? You're just applying CIP. What confuses people is because people forgot what compounding interest is and how to convert one sort of periodic interest rate to another one. Well, here's the intuitive way to think of it. But of course, if you just memorize the compounding interest equation, you can also do this too. Get the same answer, what I mean. OK. Questions, comments? All right. So the third question of the problem set is CIP with bid-ask quotes. So prices is not the assets, commodities is not the only thing that has both bid and ask quotes. So bond prices also have bid and ask quotes, and you can convert those prices to bond yields in the same way you can think about bank deposits. Okay, so I hope it's clear that bond prices has a mechanical relationship to bond yields. Yes, I don't have to explain that. I can explain it later, but you can get bid and ask quotes for bonds, and therefore bid and ask quotes for its yield. Okay, so in this case, we have bid and ask quotes for not only the prices of foreign currencies, but also in the forward rate, but as also the bank deposits as well. So bid, again, low interest rate. Ask is the high interest rate. Makes sense, right? Because high interest rate is what you get for borrowing money from the market maker. And if you want a loan to the market maker, it's going to be at the lower quote. So here again, I'm just emphasizing everything that I've talked about the first week, right? Just to explain to you how to interpret bid-ask quotes. So two ways to think about bid-ask quotes. One way is from the perspective of the market maker or the exchange. The market maker is willing to buy at the bid price and sell at the ask price. They want to do that because they want to buy low and sell high, obviously. From the perspective of the trader, you want to liquidate things quickly. And you can only liquidate things at the more expensive price. So if you want to sell something from the perspective of the trader, you have to sell at the ask price. But if you want to, bid price. And if you want to buy something really quickly, you have to buy it more expensive. Okay, so again, to reiterate trader's perspective, you can only sell low and buy, or sell cheap and buy expensive. But from the market maker, you want to buy low and sell high. Okay, so I think solving this question is also straightforward. You just have to think about which quote to use, the bid or ask. The harder part, again, is just review of your understanding of converting currencies of different compounding frequencies. Okay. So what you're given, I believe, is it's here. Yeah, you're given a 3-month forward price, right? Bid and ask quotes. But your 3-month interest rate, however, is quoted annually, APY. Okay, so what you have to do before you apply the CIP equation is to convert this APY, annual percentage yield, to the periodic return. Same kind of exercise again. So I'm just going to write out the equation here. I think, again, this is straightforward if you just memorize the compound frequency equation or conversion equation. Otherwise, intuition again is no arbitrage argument. Okay. So left-hand side here, 1 plus APY is the annual compounding return, right? APY. That's what you're quoted. That's what the question is giving you, and you want to convert it to the 3-month or quarterly periodic return. That's this entire term here, 3-month APR divided by 4, and it's taken to the 4th power because quarterly periodic returns are compounded 4 times in a year. Okay, we want to solve for R.25. Okay, R0.25 is this entire expression here because it's a periodic return. So solving for R0.25 will give you this equation here, right? Just take to the 1/4 power on both sides and subtract 1. So you're relying on this equation here. But you just have to figure out what APY is. Is it a bid or ask? Okay. So I just outlined this trading strategy here. So you can memorize it, or on the exam you can just use your intuition. Either way, I think intuition is better because that means you understand the core concept in this class. So in this case, you can check very easily after writing out this step. In this case, in which you're borrowing domestic and you're lending foreign, that you're basically plugging these two terms here. Okay. I think something is cut off here. This should be JPY, and I think this should be a minus. There should be a minus here in this JPY. I'm not sure why it's exported. I'll double check. But anyways, there should be a Y here, and this should be a minus. If you identify this strategy and walk through these steps, you'll realize that you have to use FBID, RBID, and EASK, and RASK. Okay, plug those numbers in, check how it's violated, and then you can outline the steps. Yes. But anyways, this is the answer. This is the same answers on the solution. So I'm not going to walk through it unless people want me to. It's the same argument again. So in this case, when you're borrowing domestic and lending out foreign, you have the short forward. If it's the other way, you go long forward. That's the only really big difference. When you do it this way, in this case, when you're borrowing domestic and lending out forward, you're eliminating your this return here, this exposure here. Okay. When you short forward, again, short forward means that you're selling the foreign currency and receiving domestic, and in this case, you're trying to eliminate exposure when you receive the foreign currency in the future. For the other direction, as a reminder, as a review, you're eliminating exposure to your liability side as opposed to your cash flow side. Okay. So maybe just a review here. So review, if borrow domestic, lend foreign, then you will then short forward. If borrow foreign and lend domestic, then long forward. And the short forward is to eliminate asset exposure. So asset meaning cash flow, inflow, okay? And this is to eliminate liability exposure. All right. Check the previous slides if you're still confused, because I talked about this basically close to 5 to 10 times. Okay, so I don't want to go over it unless people want me to. Okay. All right. Comments, questions? So again, this is just CIP, but with bid and ask quotes. You just need to either memorize this equation to test how it's violated, and depending on which direction, you can determine whether or not there's arbitrage profits. But just remember, when you test the other direction, these could change. F and E could change. In the solutions, I mean change as in it's not ask but bid, right? It's not ask but something else. In the solutions I gave you online, I gave you both, equations. So you can just plug and chug and just check yourself if there's a arbitrage profits. All right, and the last question is just using the CIP equation to kind of help you intuitively think what's going on when you borrow interest rates from two different, borrow interest rates and then invest or lend out in another interest rate. So the setup of the problem is the following, okay? So just summarize. Basically, you're a wine seller, and you have a future expense that you're trying to hedge against future changes in foreign currency prices. You have to buy something, either buy barrels to store wine 1 year from now, but it's priced in euros, and you want to lock in the US dollar price today. That's the setup of the problem, okay? And I'm just going to walk you through how to lock in the future price with just interest rates and a spot exchange rate in the slides. But the reason for talking about this example is because in this case, there are no forward contracts that go out 1 year in this scenario, and this happens frequently. So it's hard to make forecasts far in the future. So as you can imagine, traders are unwilling to make those kind of agreements in the FX market. So if that's not the case, but you can still borrow debt, right, at very long maturity horizons. So this is kind of what this problem is hinting at. It's like, well, if there are no forward rates, you can still derive an implied forward rates with interest rates across countries. Okay, so here there are 6-month euro forward rates, but there are no 1 year forward rates. So what you have to do is the following. Okay. So let me explain the setup of the problem first with numbers. So you start with the spot exchange rate, E. So this is the price of euros in terms of US dollars, 1.2834. And you're given two sets of interest rates at 1 year horizon. So the objective here is to lock in the future price of wine barrels today, which costs 122 euros in 1 year. You do not want to buy the barrels today because you don't have inventory. So what you want to do is to hedge the price, right? You don't want to think about price fluctuations of the euro in the future, and so you want to lock in that price today. So we kind of have to work backwards then, and to figure out what we need to do. So from this objective alone, you can already figure out that we have a future outflow of something in the future, right? But we don't need to have that money today, right? So we can actually discount that liability to time 0 to figure out what we need to have today to grow it and have enough to pay off that expense. Yes? So step 1, identify that there is we need an inflow of 122 euros to pay it off. Yes? To buy the barrels. So this is 122 euros per barrel. What we can do is we can take some money that's lower than that, right? Put it in the bank and let it grow so that we have 122 euros in the future. Yes? So we don't need 122 euros today. Let me emphasize again. You don't need 122 euros today. We only need enough so that we can put it somewhere and let it grow, right? at a deposit, in the bank deposit, so that we have enough in the future to pay off that expense. So let's discount 122 by the interest rate, 1 plus r star, and we will get some number that we need to have today so that we can invest in it and have enough in the future. Right? So we identified what we need to deposit today, 116. But this is in euros, so we want to convert that into domestic dollars. So let's do that. Let's convert 116 multiplied by E. Remember, E is the price of euros in terms of US dollars. So multiplying gives us the quantity of the quote currency, and that's 149 US dollars today. Okay. All right. So this is one of the steps. We need to deposit. We need this much amount of money today, right? 149. All right. So we can actually borrow this, right? We can borrow this money enough so that we have enough to pay off the fixed price we want, whatever it is. We need to solve for it. Okay. So let's borrow 149 and then promise to pay it back by the interest rate of the domestic R1, right? 4.25%. So 149 times 1 plus R will gives us 156. Okay, so just based on this backwards thinking, we've already outlined a strategy to kind of synthetically create a forward contract. So let me now go from forward to, from the beginning to the end rather than to the end to the beginning. So from the beginning, we'll borrow 149 US dollars today, and we promise to pay 149 times 1 plus R, or $156 1 year from now, right? So there is an F outflow of currency in the future already. Yes, we take that 149, we convert it in the spot exchange rate, right? And we get 116 euros. And then we deposit that 116 euros in the bank, a foreign bank, and we let it grow for 1 plus R star. So at the end of the 1 year, we will have 112 euros to pay off our barrels, right, per barrel. And we have a known fixed quantity that we know today at 156 USD. So just based on this backwards thinking, right, figuring out how much we need to offset the expense in the future, and then thinking about how much we need to borrow, we've effectively created a synthetic forward contract, right, or forward price. Because at the end of the day, we have an outflow of 156 and an inflow of 122 euros. Just divide these two, right, and you get an exchange rate. That's the future or forward exchange rate. All right, so let me just walk through it again, just to motivate why this is important, just for intuition's sake. So in the forward FX market, it's rare for these contracts to go out beyond, I think, 5 years. And especially if you're a business, a large corporation, you need to hedge against fluctuation in foreign currencies for long periods of time. Many reasons, because sometimes projects last decades. You may need to synthetically construct a forward contract or a forward exchange rate. And you can do this by borrowing one interest rate and lending out in a different foreign currency or domestic currency interest rate. Yes. To figure that out, we kind of go backwards, right? Backwards induction, essentially, right? We figure out how much we need today to figure out how much we need to deposit today. We figure out how much we need in the future, discount it so that we figure out how much we need to deposit today to let it grow into the future, convert it back to domestic currency, and then figure out how much we owe after borrowing that amount, whatever time horizon there needs to be. So in this case, we have 1 year horizon, right? We need 122 euros per barrel. We realize we don't need it this much today, so we discount it back to 1 year and realize we only need 116. 116 in terms of domestic dollars, just use the spot exchange rate, gives us 149. So we need to borrow this amount so that we can grow it to 122. How much will we owe after borrowing this amount at the end of the forward contract? Well, it's the interest rate we have to pay on deposit from borrowing this money. That's 1 plus R. So we have an outflow. We have an outflow of currency, inflow of currency. That's essentially an exchange rate, right? Exchange rates are basically inflow and outflow of the currencies. And dividing these two numbers will give us an implied exchange rate. Okay, so that's kind of the intuition behind CIP, essentially. Okay, comments, questions on the practice ungraded problem set. So today's lecture is actually, new topics is actually quite light. So I will go slow so that people get the intuition, because it requires some degree of mathematical abstraction, okay, and economic assumptions. So I'm not going to cover too many different topics, just focusing on one topic today. All right, no questions on the problem set, then I'll go ahead and start today's lecture on the asset approach to the exchange rate. So I kind of want to start by kind of reminding you what investors care about when they think about returns or portfolio returns. And what we're going to do kind of differently compared to your investments course. So from an investor's point of view, there's essentially, you can basically categorize into three broad concerns. The first one is obviously asset return. Asset return is just a change in price over time, right? That's what return is. And we typically think of asset returns in terms of expectations or averages. So when you look at stock returns and when you learn your capital asset pricing model, you have to somehow derive the mean return of every asset, right? And we just assume it's fixed. That's basically this is basically what asset return is referring to. It's the average return you get on a certain asset. You can do the same thing for currencies. Risk, again, similar to your portfolio management, wealth management classes, we're going to measure, we should be thinking about risk in terms of variance and volatility, right? Same thing. Standard deviation of returns is just a fancy word for, volatility is just a fancy word for standard deviation of the asset return, okay? So risk is also another concern that investors should have for foreign currencies as well. And lastly, liquidity. So that's the ease in which you can actually sell your assets in the open market. Okay. So in this class, we're not going to talk about risk or liquidity. The reason is because we're not so much concerned about optimizing portfolios. Our concern here is understanding the direction of these variables, the changes in direction of certain variables in response to other changes. Okay. So we're not so much concerned about optimizing portfolios. We're going to make some very strong assumptions about what investors care about. And when we make those assumptions, it should be clear why this model is the model that we're going to be working with. Okay? So when we think about, when we eliminate risk and liquidity and only focusing on asset return, what does that mean? That means that we're assuming that investors only care about averages. Okay? So I'm going to try to introduce the concept of risk neutrality. You may have talked about this in your derivatives pricing class or maybe your economics class. I don't know if you took game theory or something like that. These are also concepts that's used widely in economics. We're going to basically assume that investors are risk neutral, which means that they don't care about risk, they don't care about liquidity. The only thing they care about is asset return. If that's the case, along with assumptions about how well markets are close to perfection in terms of information aggregation and all that stuff, then we can actually transform the CIP equation into something that looks like expected returns. Okay? All right. So given our focus on returns, let's just talk about formally what a return is. Okay. I think everyone knows what interest rates are. Interest rate is the amount of money you get, the relative amount of more money you get after putting your money somewhere else, right? So an example is for if you have a euro deposit rate of 5% per year, if you put 1 euro in this deposit rate, you get a return of 1 point R star. So 1 is arbitrary. You don't have to put 1. You can put 100. That's what 1 plus R star means when you multiply it. Okay, I think everyone knows how interest rates work. You put some money, it grows by a percentage rate, and the amount you get is just multiplying that percentage rate by the amount of money you deposited. A return for currency is the same return as for stock prices. So stock price is current, if you use, current price minus previous price divided by previous price. Or you can look at future price minus today's price divided by today's price. Either way, right? We'll give you this kind of expression. Okay. So for foreign currencies, it's the same. We look at some future currency or today's currency and compare it to previous currency or today's currency. Okay. So in this case, let's think about forward-looking because we're thinking about forecasting. So a currency return, much like stock returns, much like bond returns, is the same. It's the future price or expected future price minus today's price divided by today's price. So I know this is kind of elementary, but I just want to emphasize that currency pricing is the same as stock pricing as stock. Okay, looking at stock returns, the same thing as looking at foreign currency returns. We still calculate everything the same way. All right, so I'm going to take some time to kind of talk about random variables here. Okay, so I hope this is again nothing new, but just to make sure everybody's on the same page, I will talk about where risk comes from. Okay. So far in this class, everything is essentially deterministic, right? When you look at the CIB equation, R and R star are both known quantities. F is a known quantity, you just check, right? Or if it's not there, you can easily back it out with CIP. And the spot exchange rate is also given. So there's no sources of risk whatsoever. So the equation I want to start thinking about now is the following. So suppose we don't hedge, okay? If we don't hedge with a forward contract, you know, when you look at the CIP no arbitrage steps, right? Suppose we don't engage in that forward contract. Then our equation will look like the following, assuming you're doing the same currency conversions. Oh, sorry. 1 plus E. E prime is future price, future spot. So on this equation here, looks the same, but all I'm doing is exposing myself to future foreign exchange rate risk. So if you do the same arbitrage steps, but you just omit that step where you engage in a forward contract, your return is actually now risky. Right? If you look at that, for example, F times or E times 1 plus R minus F times 1 plus R star, that's your return, right? But now, instead of engaging the forward contract, you just expose yourself to future E. So just swap out the E and E prime. That payoff now is risky, right? Because E can take values that you don't know at time 0. So what do I mean by that? It means that for example, E could be the following. So suppose there's only 2 states in the world. E could take on to 1 if with 50% probability, or let's say 0.5 with 50% probability. Okay. If you want to think about it in terms of a tree, you can, right? I hope maybe you've seen this in your game theory class, maybe. So you have today's spot price. Let's call it E0. And then we have future spot price, E prime, equaling to 1. And E prime equaling to 0.5. And then you have a 50% chance of this happening, and a 50% chance of this happening here. Right? So if you plug in E prime into your payoff function, given your carry trade strategy, you can there's actually two possible scenarios, right? This is a very simplified universe, okay? Only two possible scenarios to occur, what I'm saying here. You plug in E prime into this equation here, your trading strategy. So let me be explicit here. So for example, your payoff which may look like this, minus f times 1 plus r star, right? Yes. Depending on which way you're arbitraging, right? But this is an example. So you plug in E, you can do two different types of payoffs. So it's hard to kind of analyze in this fashion because it's hard to know the actual distribution of what E is, right? We don't know what variables, what's the universe of possible realizations that E prime could take. So what we do in finance, and I guess most of applied sciences, is we take an average. And how do we do that? So in this example, we want to take the expected value of E prime. We weight the outcomes, the possible outcomes, in this case, 1 and 0.5, by the likelihood of its occurrence. So 0.5 times 1 plus 0.5 times 0.5. Okay. So of course, you don't know these numbers. But as you learn from your statistics course, we can approximate that with historical data, right? Can approximate with historical data to get, I'm going to call it E hat, okay? Maybe I just do this like that. Okay, so that's my hat. So sorry, I can't do the hat notation in this here, but just know that E exponent means E hat. So E hat means that I'm just looking at historical data and taking an average, and it's supposed to approximate this expectation somehow. Okay, and I don't want to go into the hardcore math why that's the case, but you can do this. Okay. All right, so if we like to think in averages, then why don't we just take the average of this expression here, right? So we get an expected return now model. So expected return of 1 plus r equals to expected value of 1 plus r star times 1 plus, let's just do E prime over E. Again, I think it's clear. I don't have to explain why it's reduced to that, right? The ones cancel out. this will give us 1 plus r because there's no, it's 1 plus r because there's no randomness here, right? There's no randomness here. And all we are left should be the following. Expectation of E prime, just do E hat, okay? E hat over E. All right. So let me see. Note, if I take the expectation of a constant, it'll just be a constant. Agree? So what is a constant? It's some number that's fixed, no matter which scenario of the world it's going to be. So in this case, 50% up, 50% down. Well, the constant is going to be the same value either way. So you take the weighted average between 50% of a constant times 50% of a constant is still the constant. So if I take expected value of a 1 plus r, just give me 1 plus r. So another way of saying that is you can take out constants out of the expected value because it's linear. So 1 plus r and divided by e can be taken out. So all we're left is just expectation or expected value of e prime. And we can just swap that out with e hat for notation-wise. Right? So just by taking the expected value, we've arrived at the equation we want to work with. Okay? So this is called the uncovered interest rate parity. It's uncovered because we're not engaging in a forward contract. We are exposing ourselves to future exchange rate risk. And you can see this here, right? We are exposing ourselves to e prime based on this payoff function here, depending on what I think in this case you're borrowing foreign and you're lending out domestic. Therefore, your payoff is here. If you're risk neutral and you only care about averages, then you can simply just take the average of this equation, correct? So how do you take the average? You just take expected value. You don't need to know the actual distribution for now, right? In fact, we know from statistics that you can just approximate the average using historical data. All right, so the final equation here, 1 plus r equals to 1 plus r star times e hat over e, is called the uncovered interest rate parity, and this is our asset pricing model we're going to be using. And again, the fact that we can just take the expected value requires a lot of assumptions. Okay, and I'll just go through them one by one with you in the next few slides. Okay. All right, so this is, again, just reiterating just concept you should already know from your stock returns class. So what's E hat minus E over E? It's just expected returns on the foreign currency. Okay, if you swap E for P, right, it's the same thing, expected return on a stock return. But now we're just talking about foreign currency. And again, because we're talking about currencies, we like to label things differently. So when you have an increasing return for E, that just means that the domestic currency is depreciating. But that's just another way of saying that the foreign currency is getting more expensive, right? Because it's growing in value in terms of domestic price. Yes, so and second bullet point here, an investor with €1 expects to hold euros. They will actually be worth more, right? Because E hat minus E over E is, assume it's positive, then you're going to get more than what you had in 1 year if you hold on to the foreign currency. All right? So, yeah, these are just hammering in, reiterating, reinforcing just basic concept of returns, but just in terms of currency terminology. Okay, so let's finish up today's lecture. So we talked about transitioning from the covered interest rate parity to the so-called uncovered interest rate parity. It's called uncovered because we're no longer exposing ourselves. So we're no longer engaging in the forward contract, and we are intentionally exposing ourselves to foreign currency exchange risk. And you can see that, right, by swapping out the F with the E prime. The reason why we can just swap out the F with the E prime because carry traders conduct the same type of no arbitrage strategy that we outlined in the previous lectures, but we're simply omitting that step where we engage in the forward contract. So now I have to convince you that that the assumptions I'm going to make allows us to work with this model when we're thinking about expected returns of foreign currencies. Okay. Yeah. So I don't think I need to explain the steps here, right? It's the same. It's the same. It's the same trading strategy that we outlined before, in which the carry trader would do. So remember, when I say carry trader, it's just borrow low, lend out high interest rates, but without that FX rate. Without that forward contract engagement, right? So remember, when we are borrowing the foreign and investing in the domestic, we are engaging long forward. When we're borrowing domestic and going long on foreign currencies, we are short forward, right? It's to offset those exposures to either the investment return or the liability side. But for carry traders, they are intentionally not engaging in that contract because they think they can make that interest rate differential. They're basically betting that the expected return on the foreign currencies doesn't wipe out the gains, right? So remember, if we take this expression, right, and we multiply everything out, and ignore that last interaction term, we can work with this much more simplified expression here, where we can see that the interest rate differentials must approximately be equal to the so-called forward premium or expected return on foreign currencies, right? If there's any interest rate differentials I can exploit through carry trade, it will be wiped out by foreign currency returns. Okay? So in the case in which you have a positive difference, R minus R star is positive, that means you're betting that the foreign currencies won't appreciate enough, right? If it doesn't appreciate enough, then I make that gap. I make this interest rate differentials. Conversely, if you have a negative R minus R star, that means you're betting that the domestic currency doesn't appreciate enough to wipe out that difference. Okay? So that's what carry traders are doing when they are exposing themselves to without engaging that forward contract. Okay? The steps are identical, so I won't talk about it here. It's the same as the steps that you did last 2 weeks ago, just again without that forward contract step. All right. Okay. So I think I talked about this already. All right. So I think I have to kind of emphasize here how UIP, which again, it's called the uncovered interest rate parity, is different than CIP in terms of its mechanism. So CIP is all deterministic. It's mechanical. If there is a violation of CIP, that gap, the differential between 1 plus R and 1 plus R times F over E, that gap should be eliminated basically instantaneously. However, for UIP, it's different. The reason is because we have a random variable in the equation itself. That means that this inequality may not be violated all the time, right? And when we're working with E hat E, that just means that we're talking about averages. So it's more like statistical arbitrage, right? You're kind of betting that on average, your returns you can make money by exploiting interest rate differentials from the arbitragers, from the carry trader's perspective. So in the case here where you have a USD deposit that so again, USD, I usually refer to the domestic currency. Suppose the domestic currency deposit rates yields higher returns than the foreign deposit rates. As you remember from the previous weeks, when you see that gap, it means that you should borrow at the low interest rate and invest in the high interest rate. But for carry traders, again, we're not talking about arbitrage here. We're talking about averages. What he's doing is he's betting that on average he can still make some money. So the mechanism that restores UIP is more like an average argument rather than a mechanical argument. But the price pressure is the same. So if carry traders were to exploit this gap, this average gap, they would be putting pressure on E. Okay, same thing. So here they're borrowing foreign and selling foreign currencies for domestic currencies. That pushes pressure on E. E goes down. If the denominator goes down in value, the entire fraction value goes up. That's going to restore parity on average. Okay? So I kind of have to emphasize we're talking about average returns as opposed to a mechanical restoration of the parity. Okay, so that's I emphasize in the second bullet point. It's not a strict, no arbitrage argument. It is a statistical argument, statistical arbitrage argument. We're talking about averages as opposed to deterministic, actual free money on the table, right? It's not free because there is risk, right? We're just ignoring it. All right, so up to this point in this class, you should think of this E hat E, this expectation. That's what this, so in your textbook, they use a hat symbol and a lowercase e symbol to emphasize that it's an estimated expected value of the future value of the spot exchange rate. So I'm just going to use the same notation, but I'll just call it E hat E from now on. Okay. So for up to this point, you should just think of E hat E as an anchored value. It's a value that's fixed sometime. It's fixed about the future spot exchange rate, and it's not going to change unless there's new information being introduced to the markets. All right, just for now. So the only parameter that can move given this equation here is E. Okay, so if you lock in R, you lock in R star, your expectations about the future spot exchange rate is anchored or fixed. Then if there's a gap in such a way in which you have a violation of UIP, arbitrageurs come in, and restoration will only come from changes in E. Okay, so in this case, again, to reiterate what's happening, carry traders are maximizing expected returns, right? So they have incentive to come in and exploit this because expected returns is positive. They come in, they borrow low interest rate, lend out a high interest rate, but in doing so, they have to convert foreign currency to domestic currency. That conversion would put pressure on the spot exchange rate. That means foreign currencies become more expensive. So, the domestic currency becomes stronger. E goes down, entire fraction goes up. This entire right-hand side will increase in value and restore parity on average. So the case study is basically allowing you to empirically verify if UIP is true, as well as CIP. And just to give you a hint, CIP is basically always satisfied, but UIP is routinely violated. Okay. All right, so what are the key conditions for UIP to be restored? As you kind of already guessed, arbitrageurs or so-called, or just carry traders in general, have to be incentivized to come in and restore the parity. And one easy assumption we can make to, to explain why arbitrageurs or carry traders come in and take advantage of this interest rate gap is because they care about average returns. And one way to do that is to just make them all risk neutral. So let me kind of give you how give you an example of how strong this assumption really is. Okay. Consider two types of gamble. Okay. Suppose you have a gamble that has a payoff of -1 and with 50% chance, and -1 with 50% chance. So that's gamble 1. Gamble 2, payoff of -1 million with 50% chance. Sorry, there you go. And plus 1 million with 50% chance. All right, so what's the expected value of each of these gamble? Can someone tell me? Yep. Yes, 0. So we take the average. That's just expected value. Expected value of gamble 1 is equal to expected value of gamble 2, which is equal to 0. All right, so can somebody tell me the variance of these two gambles? Let's just do it by hand. We can. So variance of gamble 1 is equal to 0.5 -1 minus 0, right? So we're demeaning each of these values, right? And then squaring it. Plus 0.5 times plus 1 minus 0 squared, right? So just eyeballing it, it's like the number is not that big, right? It's 1, right? I think it's 1. Whereas the variance for gamble 2, that's 0.5 minus 1 million minus 0 squared plus 0.5 minus 1 plus 1 million minus 0. Okay. That is some crazy large number, right? Minus 1 million squared is some big number. This is also some big positive number, so it's a gigantic number. So from the perspective of a risk-neutral investor, which gamble would you prefer? Anybody else want to? Is it only one? He's actually indifferent. Yes? Risk-neutral means they only care about expected value. They don't care about risk. I can show you the math, but I think I can show you the math to define risk neutrality, but I think that's a little bit much. So just to simplify everybody's life, risk neutrality literally means they only care about expected value. That's the only thing they want to maximize. Whenever the expected value exceeds 0, they will come in and make a trade. Okay? So in this case, in these two gambles, where you have a very small payment, symmetric payment, -1 plus 1, minus 1 million plus 1 million, the same expected value, right, equal to 0. The risk-neutral investor is indifferent between these two gambles. All right? If you are smart and risk-averse, like any normal human being is, you would obviously prefer gamble 1. Yes? If you had to choose. Otherwise, you choose not to play. Yeah. OK, so as you can see, it's a very, very strong assumption. But remember, our objective here is to kind of understand how to forecast the direction in which certain variables move. So it's OK. That's my explanation so far. OK. We're just trying to come up with equations to work with so that we can make forecasts about macro variables and spot exchange rates and so forth, interest rates as well. OK. All right. So that's the second bullet point here. The first bullet point, I think it's also fairly strong. We talk about market efficiency, but we typically think about no transaction costs, right? When we think about efficiency, I go to the market to buy something, I'm not charged anything. The price is probably just pennies. Well, it's not only about transaction costs, it's also about information, right? If markets aren't efficient, then it could mean that there is private information that's not being incorporated into the markets, and therefore people with privileged information, they can make profits, right? That information, if it's not fully reflected in the market price, then E hat E could be wrong. Yes? So information is not only about what's about today, things about occurring today, but also everything far in the future. And when we say markets are efficient, we're also saying that our beliefs about the future is also, on average, correct. So you may have heard about this term called rational expectations. So are people's beliefs about the future correct on average? Well, it's hard to test, but that's the assumption necessary for us to work with this model. Okay, so let me summarize again. What are the assumptions necessary for us, or sufficient for us to use UIP as an asset pricing model to think about how E changes with respect to changes in R star, and other maybe changes in expectations about, anyways, yeah, just changes in R and R star for now. Well, number one, you need risk neutrality. The reason why you need risk neutrality is because you need to make assumptions about the investors that forces them to restore this parity, right? So if it's violated, why would traders come in to, borrow low, invest high, and restore this parity? Well, they need to be risk neutral. They have to care about expected value, solely about expected value, and nothing else. Okay, that's a sufficient assumption to restore parity. Okay, so of course that's wrong. People on average are risk averse. Even if you aggregate everybody's preferences, I'm sure most people are risk averse. And there are ways to augment UIP to capture additional risk premium, but that's later. But I'm just telling you, there are ways to augment this model to capture these additional risk compensation requirements for different average investors. All right, so that's the first assumption about incentivizing carry traders to come in to restore the parity. The second assumption is about E hat E. Okay, expectations about future spot exchange rate. So if expectations about the spot exchange rate is wrong, then it's possible UIP can be violated. And that means it's possible that carry traders can make profits on average. If the market isn't doing its job of aggregating people's beliefs, aggregating information about private and public information, then E may not reflect the true nature, the true direction of the spot exchange rate today. Yes? So for now, we're just going to assume that markets are good at aggregating information. We are, on average, good at forecasting the future spot exchange rate, and therefore E hat E is going to just be anchored. Okay, it's going to be some constant. We'll think about changes in E hat E later. And we're just going to be focusing on changes in R and R star next week. But that's the direction we're going into right now. So we want to link this asset pricing model to basically monetary policy of the domestic country as well as foreign countries, right? Because interest rates are directly controlled by central banks of foreign countries. All right, so I'm going to introduce to you some graphs, okay? And whenever I do graphs, I will primarily be working with this simplified version of UIP. So just to remind you where this comes from, it comes from expanding this periodic version of the UIP, multiplying everything out, and then realizing the last term when you're multiplying a fraction, some number less than 1 by another number that's less than 1, that number is going to be very small. And we can just focus on these
first two terms. Okay, so the ones cancel out, so it's just R, R star, and this expected return on foreign currencies. All right, so we will first talk about, I guess, the intuition, I guess, behind this parity using some time graphs. Okay, so what I'm going to do is I'm going to rewrite this expression into this expression. You can see this because we can divide this both out, move this term over here, and move the expectation of the spot exchange rate from the right side to the left side. Okay, so now we have this gap here, right? The gap between the spot exchange rate and the future expected spot rate versus the gap between the foreign interest rate and the domestic interest rate. And we want to say that these gaps have to basically match each other inside or in direction. Yes, in direction. All right, so let's consider the case. So let me write that down here. E minus E hat E. I'm just going to write E hat E like this way. And R star minus R. I believe it's E, okay. Is that right? Okay. All right, so suppose you have R star greater than R. That means this gap is positive. Then that means this gap also must be positive. Right? So at time 0, so let me give you the explanation of the axis. So the y-axis is the nominal exchange rate. So nominal just means we're differentiating between real, as I introduced to you first week, but nominal exchange rate just means E. Okay, so our y-axis is just E, and our x-axis is time. So I'm providing a visual representation of what rational expectations means. So suppose this is, for example, 90 days. Maybe I'll just write 90 days here. 90 days meaning is to match like the deposit rate. So suppose you have a deposit rate that's just for 3 months. Oops. And we have anchored expectations. And I'm just going to draw a dashed line here. That's our E hat E. Okay. Now, given that R star is greater than R, that means that the current spot rate must be above or below E hat E. Above, right? Because it's positive. So let's just put the spot rate. I'm going to use E naught to indicate that it's today's spot price, not the future one. All right. So what rational expectations means is that over time, the spot rate must converge to our expectation about the future spot rate. Okay? And therefore, this gap here represents R star minus R times E naught, right? So what does this tell us? That means that if there's any change in R that makes this gap larger, then the spot rate has to adjust, given that we have anchored expectations, in such a fashion that allows us to appreciate or depreciate the currency enough in the future, right? So in this case, if r star is greater than r minus r is greater than r, so if r star minus r is greater than 0, then we must have domestic appreciation. So E decreases. All right, let's do the other direction. So again, let's anchor our expectations here. Just going to use the dashed line to represent that. E hat E again. But now we have interest rates going in the other direction. So if interest rates are going the other direction, that means this term is negative. Therefore, this term must be negative. And that means that our spot exchange rate has to be below, right, our E hat E. If R star minus R is negative, then we must have domestic depreciation. All right, so our first task is to link the UIP with the money market. Okay, so the money market is just the debt market for U.S. Treasuries, for sovereign debt, essentially. Okay, risk-free, essentially risk-free assets. Risk-free assets are the value of risk-free assets are controlled by interest rates, and that's set by the central bank. So we'll talk about that next week. But this is the reason why we have the y-axis, the spot exchange rate, and the x-axis as an interest rate return. So R star plus E hat E minus E over E, if UIP holds, is equal to domestic interest rate, correct? So our our x-axis is interest rates, and we're going to link this axis with another y-axis next week. Okay. So if we were to plot UIP based on these two axes, based on E and R, it's going to be a downward sloping curve. So let me write out the equation for UIP in another way, but it's the same. It's the same expression, okay? But it could make understanding the shifts of these curves easier in the future. So all I'm doing is dividing E hat E minus E by E out. So E hat E over E minus E over E is 1, right? So this is where the minus 1 comes from. All right. So you can see the negative relationship, right? Let's say we decrease E, that means that this entire right-hand side is increasing. To restore parity, interest rates have to also increase, right? So as we go down this way, we have to go out more this way. So it's downward sloping. Yes? So, I mean, you can verify this just to emphasize, I guess, the level of E. This is a very high E. So that means that very weak domestic currency, high E, low E, and very low E. Very low E means very strong domestic currency. Okay. And emphasize again, this axis here is just interest rates. Yes? Okay. Comments, questions? So I hope you're convinced that it's downward sloping. Yes, you can do the other exercise, right? If you increase E, the denominator will get larger. That means this entire expression gets lower. This entire right-hand side gets smaller. You have to adjust R lower to make parity, to restore parity. So again, increasing E, R goes this way, and therefore you go higher. Yes? All right, so how do we visually link UIP with the money market? Well, we can simply just draw, for now, a vertical line to indicate the interest rate that's set by the government, the domestic government. And therefore, the UIP curve, which I will just represent as this equation here, R star plus E hat E minus E over E. So given R star, R and R star, given our expectations are anchored and fixed for now, we can actually identify the market clearing spot rate, right, which is the intersection of these two curves. And that intersection will therefore lead us to the so-called equilibrium spot exchange rate. Okay. So now we can actually visually understand how the spot exchange rate changes when R changes, right? Of course, we'll talk about the mechanism in which R changes. That's the change in money supply. So lots of things happened recently, so we can obviously do many case studies. But that's the idea. We can visually understand how the direction in which the spot exchange rate moves given changes in interest rates, which is basically affected by literally everything. Macro shocks, by war, by, again, obviously things like quantitative easing, right? If you have decreases in R, you can visually now know, right, how things should look, right? If there's quantitative easing, we have changes in interest rates, then the line is going to move, and now you know the direction in which E must change, right? So this is our visual tool we're going to be working with throughout this course. All right, in fact, that's exactly what we're going to do. We're going to go through these steps, and then I'll go through the intuition, and I'll write down the steps and kind of comment on the mechanism. So again, it's downward sloping. We should all agree, right? And we're going to have a starting point. And let's suppose we have an increase in interest rates. So I'm going to use R for the previous interest rate. I'm going to use R prime to note the change. Okay, the change in interest rates, the new value. So just by looking at this graph, we already know, right, without even thinking about logically the intuition or the mechanism, we can actually make a forecast, right? It's the new intersection point between the UIP curve and the vertical interest rate curve, and we can already tell if the central bank decides to increase interest rates, which it has been doing now, we should observe strengthening of the domestic currency. Right, and I'm going to use E prime to indicate, again, the change, the new level of the spot exchange rate. All right, so let's talk about the mechanism. What are we observing? Domestic appreciation today. All right, so just to remind you again, we're not touching expectations. It is taken solely as an external variable. We assume it's anchored. So let's just fix expectations. So that's E hat E is constant. What's going on from a equilibrium kind of understanding? We have interest rate differentials increasing with greater returns on the domestic currency. Yes? So suppose we already have an equilibrium starting point. Suppose UIP is satisfied. We have a sudden increase in the domestic interest rate. Obviously, that's going to change UIP's inequality. Yes? So from an equilibrium perspective, only acceptable equilibrium, market equilibrium, if there is equivalent capital loss in the future, or domestic depreciation. So capital loss must wipe out interest rate differential. So I'll reiterate the carry trader's perspective in a bit, but this is again the equilibrium perspective. If the parity has to hold, then something must change today to offset the larger gap between R and R star. So in this case, you have R increasing relative to R star. So the return E hat E minus E over E must also enlarge as well. If our expectations are anchored, right, then the only moving parameter we have is E, right, the spot rate. So in order to compensate, to wipe out that larger gap, E has to move in the direction that eliminates that larger gap. And E can only move in one direction, right, which is down. So in order to get that sufficient depreciation of the domestic currency, so using words, to get that sufficient depreciation of the domestic currency has to actually appreciate today to wipe out the larger gap. So I'm just using words to describe the equilibrium concept, right? You can see that in the math, and I'm just assigning words to it. Okay, so let me repeat again the equilibrium explanation. So if we believe that UIP must hold, okay, and you have a sudden change in interest rates that makes the interest rate differentials between R and R star larger, then there must be a change in the expected depreciation of the home currency term in such a direction that wipes out that extra gap, right? Given that expectations are anchored, E can only move in one direction, right, which is down. What that means is that the currency, the domestic currency, basically has to appreciate today so that it has enough room to depreciate to wipe out the larger interest rate differential. So that's what's going on in the equilibrium sense. Okay, so if you want to think about it, you don't have to think about it that way. You don't have to. If you don't, you can also just think about it from a carry trader's perspective, just expected value, right? You have a larger gap. You have a gap between R star plus E hat E minus E over E, right? It's larger, so let me use the correct notation here. R prime, right? It's R prime because it's a new R. So new R changed in such a way that violates UIP, right? Such that the left-hand side is now larger. Carry trader's perspective. Come in, borrow foreign, and invest in domestic or lend out in domestic. But when I borrow, I have to convert foreign currency to domestic currency. In doing so, I'm selling foreign and buying, or in other words, buying domestic. That's going to put pressure on E downward, right? Because you're buying the domestic currency. So E moving downward is the same thing as saying that the domestic currency has to appreciate today, right? Otherwise, there's going to be average carry trade profits, correct? But whatever I just described is exactly what I just said from the equilibrium perspective, right? You have to allow the domestic currency to appreciate today so that there's sufficient larger gap for the domestic currency to depreciate in order to wipe out the extra larger gap between interest rate differentials. So from carry traders' perspective, which is fine if you want to use this. If this is easier for you to understand, it's fine as well. So what you would do is you would borrow foreign, lend out domestic, but converting foreign to domestic will increase or decrease E. And so that means that domestic currency appreciates today. Okay. Comments, questions? So we'll go the other direction too, just to emphasize the intuition. All right, so suppose there's an increase in foreign currency interest rates. So that means we are changing this term here. Okay? So how does the curve move if it does? So for those of you who have a hard time working through the math, the intuition is the rule of thumb is this. If we are simply changing variables that's on the axis, then we're moving along the curve. When we're changing variables that's not shown on the axis, that will lead to a shift in curves. So that's the rule of thumb. But if you work through the math, then it should be clear. Okay. So since r star is not on the axis, what's going to happen? The curve is going to shift. Now, let me explain to you mathematically why that's true. But let me first draw it out. R star prime plus E hat E minus E over E. Okay, and this is the starting point, and this is the predicted direction of the spot exchange rate. So let me explain why it shifts up. So what's happening is the following. So remember, if we have R star prime, that means that now we have the following violation of UIP, right? R is fixed, right? R is fixed. Only R star is changing. E hat E is anchored, so our expectations are not allowed to change. So the only other free parameter that can move is E. So if we have an increase in R star to R star prime, we need to adjust this term downward, right, to decrease this entire right-hand side so that parity is restored. So how do we do that? Well, E can increase, right, to lower the entire denominator here. And therefore, this term can be negative. And that will reduce R star prime, correct? So let me say that again. For a given R, we increase R star, correct? Increasing R star means there's a violation of UIP. How do you restore UIP? Something has to change in this term here. The only free parameter we have is E. So E must move in the direction that reduces the entire value of the right-hand side. How do we decrease the value? Well, we can increase E to lower this term here. and restore parity, or close to parity, correct? So that's exactly what this point to this point is what I just described verbally. So it doesn't matter which r you fix, right? No matter which r I choose, I must have a higher e, correct? So verbally explaining, so visually explaining, fix r, right? Fix r. For every fixed r, if I have an increase in r star, I must have a higher e. So the entire curve, therefore, must shift up. And you can work through the reverse yourself. Okay. All right, so let me quickly explain what's going on mechanically, or the mechanism. So an increase in E is domestic depreciation. So what's going on in terms of equilibrium sense? We have greater interest rate return on foreign currency deposits. Only acceptable market equilibrium if interest rate differential is wiped out. So that means that domestic currency must depreciate today. Right? It must depreciate today so that it can appreciate more in the future. Right? That's what it's saying. So let me quickly do the carry trader's perspective. We have borrow domestic, lend foreign, convert domestic, convert to domestic to foreign, and that will depreciate. All right, clear? So the last example I'm going to go through really quickly is change in this, okay? But the way we determine how the curve shifts is exactly the same. So let me do it now really quickly because we're running out of time. So if we have an increase fix r, you have e prime and not. We have r star plus e hat e, and we have this one. R star plus e hat e prime minus e over e. And UIP is violated in such a direction, same direction as last time, as the last one. So just to explain quickly how to shift the curve, it's violated this way, right? So that means that we have to adjust this term again in the direction that reduces the entire right-hand expression downward. We can do this by increasing e. So fix r. So for every r that we choose, we must have a higher e to restore parity. So yeah, so any r that you choose, we must have a higher e. So the entire UIP curve shifts up. All right, and then it's the same logic as the previous slide in terms of its mechanism, right? The same identical logic. All right, so just to give you a summary of UIP and its ability to forecast, well, so CIP, as you will confirm in the practice homework as well as in the case study, CIP is almost always true. You can check that, yes, arbitrageurs do a good job in removing free money off the table. UIP, unfortunately, always fails, and I think, or almost always fails. And I think it's quite obvious if you think about, reality. Not all countries' deposits are safe, right? If you think about Brazil, think about Argentina, think about these risky countries that have risky debt, these two deposit rates are not comparable in terms of its risk. And obviously, you have to have some sort of risk premium for investors to take on those deposits at those countries. Other reasons why UIP might fail is because, again, markets are inefficient at processing information. And so the entire EHAE could be out of whack, and UIP can be violated as a result. OK? And of course, there could be, again, these are all, the last few points are because EHAE is just out of whack, not measured correctly, not capturing all information. All right, so I want to kind of conclude, like, are currency markets efficient? There's disagreement. So we have some central bankers saying that basically there's no way to make money from interest rate arbitrage, as confirmed, as said by Alan Greenspan. But if you look at these carry trade ETF funds, they do actually make some noteworthy returns. So, this is an ongoing topic that a lot of finance practitioners and academics are studying, and they're basically trying to identify different sources of risk premium. Okay. All right. So